Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 243rd VideoCast podcast live from Atlanta for the week ending June 13th, 2024. First, some family updates, then we'll get right down to it. A lot of great stuff to cover this week. First and foremost, I want to thank my friend Jackson Houck for having me to the Piedmont Driving Club yesterday. We played 18. It was unbelievable. What a beautiful course, especially those water holes 16, 17, 18. I couldn't have struck the ball better, and we had a blast, and I couldn't have putted worse, which is par for the course, but I was still able to lower my index by 0.7 of 1 point in one day, which is a good sign. And I've got everyone's going to give me a hard time about this. I got 2 Lab Golf broomstick putters on the way. Yeah, it's that bad, ladies and gentlemen. I am going to conquer this putting problem and put it all together one way or another. So I'll play the silly looking broomstick putter for a while until I get my head straight, and then go back to a normal putter. but there we go. So thank you so much, Jackson. That's the Piedmont Driving Club clubhouse there in the background. That's one of the water holes. Just an amazingly fun time. Also, let's see, what else did we do? We took the girls to Chick-fil-A headquarters for the behind the scenes tour, and this is me in front of the magic safe where they store the 7 special ingredients for Chick-fil-A sandwiches. As you can see, I'm trying to open the combination without much success. This is the founder's office here with a bunch of Remingtons, etc., with me and Mimi and Annabelle, which was fun. This is Mimi and Annabelle in front of the Batmobile, which the founder had a car collection. That was pretty cool. There's Caitlin, Annabelle, and Mimi, I guess with life-size Chick-fil-A sauces there in the pose. I'm telling you, these 3 are Chick-fil-A maniacs. I mean, I think they eat there every single day. I think one day maybe Annabelle will get a sponsorship with them, for fueling her medals with Chick-fil-A. Then they had this special kitchen where they're trying out ideas in the kitchen, and one of them was they were eating pizza at Chick-fil-A, and they said it was delicious. So don't know what to tell you on that one. Then I want to thank Steve Jadish for having me to Dave Matthews concert while I was down here. Steve is from Philadelphia, and he was down here on business. He is an insurance guy. They do shared and layered property and inland marine placements. He had a bunch of his amazing colleagues and teammates down, and friends and their wives, and it was just such a special time. Number one, we had a blast at the concert. We had a blast talking all concert long, getting to know each other, and also seeing just the impact that many of his colleagues and his friends and even his friends' wives were giving me suggestions for things to do with Mimi and Annabelle while we're down here. So it was really just a special time, and I want to thank you for that. Absolutely phenomenal time. So that's the sign there, and that's Dave. By the way, everyone knows I'm a huge country guy, but Dave, I haven't been to a Dave Matthews concert in 30 years. No, 20 years, excuse me. Let's see, no, 1996. Yeah, 28 years. Unbelievable. And he gets better with age. So all I can tell you is that was phenomenal. And then we went to the Carlos Museum here at Emory this morning. That's me and Annabelle. We did the Egyptian, Greek, and Roman antiquities rooms. That is Mimi with me, Mimi and Annabelle. So that was a lot of fun. And then last night beforehand, as a matter of fact, Steve recommended this, was a steakhouse called Little Alley Steak in Buckhead. look, I've had a lot of steak in my day. This place was incredible. And you want to ask for Amber to be your waiter. And Mia is the host. She also goes by Mimi, by the way. She shared with us. And of course, as is par for the course, Mimi always unequivocally orders the most expensive thing on the menu. I literally don't think she does it on purpose. I think she just has good taste. So she got the A5 Wagyu in Buckhead, and for those of you who know what that is, when she ordered that, it was funny. The lady was like, "Well, how many ounces do you want?" She's like, "I don't know, 20." And I was like, "Yeah, why don't we tamp that down, memes, and go for nice sized Wagyu, and you can get a fillet on top of it." But man, that was spectacular. So definitely check that out when you're down in Atlanta. That one was the Buckhead branch. And by the way, ironically, I did not request this table. Look what's in the background. It looks like a Remington bull. Let the bulls run wild. I got to get one of these for my office. Absolutely phenomenal. Also want to thank Nick Saltarelli over at Midday Squares. He's been a long-time listener, first-time caller. He's building a company with a young guy with a goal in mind to get to 100 million of revenue. He's into Costco already with these Midday Squares. Super aggressive, super after it, and I really love people that are just got grit and going for things in life. I think their newest brand is Almond Crunch, which they sent over, was delicious. They've also got the brownie batter, crunchy peanut cookie dough. Look, y'all have no idea the amazing people that listen to this podcast. And for that, I am exceptionally grateful. And I come to play every single week with as much value as humanly possible. Just meeting with some of you. Got a couple meetings tomorrow as well. By the way, also really want to thank, I also got an invite from Chris Cannon over at Piedmont Jets to play Atlanta Athletic, and I really regret that I had to pass on that because I had other stuff going on. That's a course I've wanted to play for a while. Hope that'll be available next time I'm down, because that would be terrific. But just really great people. And I always ask people, what do you like the most about it? What do you think could be improved when I think of it? And just the feedback that I get and the difference it's making. Some of Steve's colleagues were telling me how they're halfway through the Intelligent Investor book, and they're reading the Buffett letters and how it's changed how they think about stocks as ownership pieces in real businesses. And when I hear that stuff, you don't know. You just give up a day of your life every single week and deliver as much value as possible, and you hope it falls on good ears that are going to really benefit from it. And when you just hear the stories in person and you can see in their eyes that they're really earnest in what they're telling you, it makes it all worth it. So very grateful for that, and very grateful for all the longtime listeners, all the longtime clients, and everything that this little community of hedge fund tips with Tom Hayes has become. Very, very grateful for that. So with that said, let's move on here. Want to thank Chibuke Ogu for including me in his Reuters article this week. And this morning at 9:30, after the Dave Matthews concert, I had the opportunity to do the Money Show virtual expo for accredited investors. Some of you were able to get on, and for the rest of you, we have a proprietary cut of that, which we're going to play right now. We went in through 3 holdings and picks that we like. Again, this is always opinion, not advice. You can click on terms at hedgefundtips.com. Always speak to your financial advisor before doing anything. We don't know your situation. We deal exclusively with accredited investors and qualified institutions. But with that said, here we go.
Ladies and gentlemen, I want to thank you all for joining us today. Our first speaker for today is going to be Thomas Hayes. He's the founder, chairman, and managing member at Great Hill Capital. So without further ado, it's my pleasure to introduce him to all of our live viewers. You can type your questions into the chat box. We'll try to leave some time at the end to get those questions answered. With that said, I'm going to hand it over to you, Thomas. Thank you so much.
Thank you for having me, and welcome everyone. Good morning. I'm very excited to be here at the Money Show yet again, and want to cover. Many of you know me as Turnaround Tom because we like to buy out of favor, high quality businesses when they're on sale, and we're going to go through just a few of them for this year over the next 20-30 minutes, and I think you'll find it pretty valuable. The framework that we use and the opportunities that we believe in are in the market. As always, this is opinion, not advice. For terms, go to hedgefundtips.com. But a little background on me, it's one thing to listen to my ideas. It's another thing to know why it may make sense to listen. I've got over a decade and a half in the hedge fund business, long short equity manager. I am the chairman and managing member of Great Hill Capital. And many of you know me from Fox Business, CNBC International, Yahoo Finance, BBC, etc. And for those of you who saw the movie The Big Short, I worked for the character played by Brad Pitt, named Ben Rickett in the movie, something else in real life, and had a phenomenal time working with those guys, and they were featured in the Michael Lewis book and movie. And then prior to that, I was at a fund called Bedford Oak Advisors, and in that role, I was placed as COO of a public company we had, and my job was to sell off non-core assets and then use that capital to source, negotiate, and close the purchase of an asset manager. And the real value in that exercise was over the period of a year, I interviewed about 100 different asset managers, all different strategies, value, growth, core, everything across the board. And I was able to see which strategies worked, which strategies didn't, which were cyclical, which were durable. And we did ultimately, I was able to buy an asset manager with $1.6 billion under management in that role. And that was phenomenal. And then prior to that, I was at Columbia University. So who we are, Great Hill Capital runs a long short equity format for accredited investors and qualified institutions. We run that in separately managed account format. We charge zero management fee. We charge a performance fee only. And we've developed a reputation over time for benefiting from sector stock and general market dislocations, periods of distress. So basically, when everyone is running out of the movie theater, we are running back in to see how many people left their purses on the seats and left money on the table. And that's where the real opportunity comes. We avoid situations where everyone is basically crowded to one side of the boat and the asymmetry to the downside is high. In other words, we don't chase shiny objects. Hedgefundtips.com is where we post our weekly market outlook and research notes. That's kind of like a personal blog that we do. So every Thursday, we do a comprehensive market analysis. We cover some of the positions that we have and do some in-depth analysis. And then we also have our famous podcast called Hedge Fund Tips with Tom Hayes. This is top ranked in the hedge fund category. We do it every single week. You can just search on YouTube or go to hedgefundtips.com. And not only do we cover different positions and market analysis, all free of charge, by the way, but we also do a section called Ask Me Anything. So viewers, the longtime viewers, first-time viewers, will submit their questions about a company, about a stock, about markets, about macro, and we'll answer it right on the podcast VideoCast every week. And people, that's become extremely popular. We had no idea that would be so popular, and we're very, very happy about that. So our strategy simplified as we move forward here to some ideas that can be helpful for you. We make our money buying on weakness and selling on strength. I know that's not very popular, but your grandma all taught you the same thing, to buy low and sell high. everyone knows this. Very few people do it. And there are a few reasons for that. Why do we have confidence to step in when others are bailing? It's rooted in deep research and the premise that the more price becomes dislocated, the more risk has come out. Most people view it, if a stock is down 50 or 60 or 70%, oh, that's a really risky stock and a really risky company. But if you actually kind of use the Superman glasses and look beneath the surface, sometimes you'll find that it's headline risk or temporary industry risk, but you'll look under the surface and you see, wow, wait a second. Revenues per share are still growing. Earnings per share are still growing or temporarily impaired in some cases. Free cash flow is still growing. Why is the stock down 50%? And then you can look through and find out why is the stock price? What is the bearish case? Why are people so? And usually it's an overshoot. Just as the market and individual companies, the price overshoots to the upside on some perceived positive news, it also dramatically undershoots in despondency on the downside, not related to fundamentals. And if you learn how to look under the surface and see the business, I say this all the time. I said, if you were going to buy a local delicatessen in town, you wouldn't be saying, what's the stock price of that delicatessen? You would be saying, does this business make money? And if it makes money, and if it has a certain level of cash flow when I take it over, how much am I willing to pay for that money now? If it makes $1 million a year, am I willing to pay the owner $3 million, $5 million? And oddly, with stocks, people just throw caution to the wind and they just say, is the price going up? Okay, then I want to buy some. Is the price going down? Okay, do I want to buy some? And that is very difficult to outperform over time when you're following the herd. You can't get that alpha and take advantage. So most market participants see volatility as increased risk. We view it as increased opportunity. That's not just to say buy any stock that's because the price is down, because some deserve to be down and some will go out of business. It's buying high quality businesses when they're temporarily on the operating table, not on their deathbed, heading out of the hospital. So our investment philosophy in a nutshell for clients, for ourselves, for everything we do is modeled after Warren Buffett. Great investment opportunities come around when excellent companies are surrounded by unusual circumstances that cause the stock to be misappraised. So excellent companies is the key there, and short-term misappraisal. So general macro overview here. We don't spend a whole lot of time on macro, but you can see the 10-year cycle of the Dow Jones since 1897. And this is by year. So 0 would be, call it 2010 or 2020. 1 would be 2021. 2 would be 2022. 3, 2023, etc. So actually, so far, this decade, from 2020 till now, is kind of following the pattern that we've seen historically since 1897, which is the second year is weak, which we had in 2022, about a 25% drawdown in the S&P. We had some recovery last year. The fourth year is kind of up to flat. And then fifth, sixth, and seventh tend to be the strongest years of the decade. And we're coming right into that right now. So the other thing to keep in mind is earnings are supportive of the strength that we've seen in the stock market. This year, estimates have held right in. They got down to the low 240s for the S&P 500, but now they're up towards 245, which implies 11% earnings growth this year. And for next year, it's 278, which implies another 14% earnings growth. So one of the things you hear in the media quite a bit is the stock market's too expensive because it's trading at 21 times earnings or something along those lines. If you look at the stock market since 2020, the compound annual growth rate of earnings has been high single digits, around 6 to 7%. And the average multiple was about 17 times on 6 to 7% growth. So for the next couple of years in the catch up, we're going to have earnings growth of 11%, 14%. And if you think about that in terms of price to earnings growth, the multiple is actually quite low because, yeah, 17 times earnings is more normal, but if earnings are only growing at 6 or 7%, that's a pretty high PEG ratio, almost 3 times. But here we have a situation where earnings are going to grow double digits and the multiple's only up 4 times. So you're basically looking at a 2-ish times PEG ratio or slightly below a 2 versus historically a 3 times. And that's why we think that we do have a little room upside here, number one. And number two, productivity is increasing, earnings are increasing. So things are looking pretty constructive. So you have to be wary of people saying just on the basis of a simple metric that stocks are too expensive. Some stocks are, and I think the real value, as everyone knows, there's been a lot of push by a smaller number of stocks. Breadth did expand in the last year, and that's been a positive thing. But of late, it's been a handful of stocks, and I think the next phase is going to be, now that you saw the PPI today, you saw the CPI, that the Fed is moving to a less restrictive stance towards the back half of the year, probably 1 or 2 cuts. That the rest of the market is going to start to outperform, and those that have carried the general index price may underperform. That doesn't mean they'll do bad, just not quite as well, and won't bear as much responsibility for driving the indices moving forward. Here we are in the long view. Why do we have that constructive view? First and foremost, what we've seen over the last 100+ years, you see this period of sideways consolidation from 1928 to basically 1948. The markets did nothing. And then from 1948 to 1968, you had a 2,300% return in the S&P. Then you had a 17-year sideways consolidation from, call it the 70s to the early 80s. And then from 1982 to 2000, you had another 2,300%. And then sideways again from 2000 to about 2016. And now we're about halfway through a secular bull. And you say, well, that doesn't make sense, Tom. Why is it that the market goes basically sideways for 15 to 20 years, straight up for 15 to 20 years, then sideways for 15 to 20 years, then straight up for 15 to 20 years? And a lot of this has to do with demographics. People spend in the developed world and the developing world the most amount of money between age 33 to the early 40s. That's their spending cycle, family formation, housing formation, etc. And that's when you get the biggest boom in the economy, the biggest boom in the stock market. And we're about halfway through. We've got about 72 million millennials around age 33, 34, 34 and a half. So we really do have another 5 to 8 years of massive runway. And for those of you who think we've had a big run in the last few years, I think you're going to be surprised, just like in the 1990s and in the 1960s, that this run is about halfway through the cycle, and based on spending, based on family and housing formation, we're going to continue to go higher. I'd start to get nervous in the early 2030s, ladies and gentlemen, but we'll worry about that then. We've got a few more money show presentations before that time comes. So, when the music's playing, dance is really the message I have for you. So pick one. This is an out of favor pick, which is PayPal. And what you can see here, the reason I just put this simple chart, you can see the stock is down materially, some 70-80% off of its 2021 highs. But when you look over to the right, what you'll see is revenues per share have continued to grow. Cash flow per share has continued to grow. Earnings per share has continued to grow. What's happened? You've had a de-rating, not of the fundamentals of the business, of the multiple of the business. So while it's historically traded at an average PE of 25 times, it's now trading around 14, 15 times, a little less than that on forward earnings. And then you can see throughout history, and even continuing now, it's been a consistent compounder of capital in low to mid double digits, depending on if you're looking at total capital, return on invested capital, or return on equity. And those are the type of high quality, excellent businesses when they're misappraised. So you're saying, well, Tom, this doesn't make any sense. Like we started this out with, if you look under the surface, everyone's running out of the building. What do they see that we don't see? So what the world has been, or the analyst community has been scared about, is the fear of declining margins and increased competition. So Braintree, a lot of people say to me, well, I don't use PayPal anymore. I say, well, did you take an Uber today? Did you order a concert ticket? I got to go to Dave Matthews last night down here in Atlanta, where I'm traveling. And all of those businesses actually run through Braintree, even though they don't say PayPal. PayPal owns Braintree. And what happened, that's kind of a commoditized business, but they do have 10% of total enterprise spend. So $500 billion they process, about $500 billion that they process through those white label businesses. And the fear was their take rate, their margin has continued to compress. That is now changing with the new CEO, Andrew Chris. If you look at fast checkout and some of the initiatives that they laid out at the beginning of the year, their conversion rates are going from industry-wide from 40 to 45% to 80%, and a lot of data. PayPal has one of the greatest data businesses. They know more about consumers than effectively any other business in their space, and they're going to be able to monetize that and enable merchants to have higher conversion ratios, faster checkout, quicker checkout, offer promotions. And we're starting to see that because take rates and margins did trough recently, as Andrew Chris, they promised they would when he came in as CEO in September of 2023. One of the things that we like to do in turnarounds is bet on the jockey. This is very important. Alex Chris ran the small business division at Intuit, which was about 50% of the revenues of Intuit from 2008 to 2023. During his time running that 50% of revenues, the stock was a 38 bagger. Okay, went from $18 to $707, and he was driving 50% of the bus. That is a big deal. And the other thing to keep in mind is the free cash flow. You know, the number one thing with a turnaround situation is, do they have the runway? Do they have the cash to execute the turnaround plans? You know, if it's a leveraged balance sheet, they have no cash, or they're losing money, they could go to zero. In PayPal, it's not the case. They're generating $5 billion of cash per year, and give or take free cash flow, and they're buying back $5 billion a year of stock. What does that mean? It means that your same slices in the pie, percentage of ownership in the business, get larger, even though you're not buying more shares. Your slices of the pizza pie are getting larger as they're buying in and retiring shares. That is a big wealth builder and a key thing that Buffett said. So he's shifting Braintree's pricing strategy to value-based pricing to increase profit margin. He's firing unprofitable customers in Latin America. Everyone's focused on the active users. They've got 427, give or take 430 million, and they lost a couple million. Why did they lose a couple million? Because those clients that were losing them money to service, they're actually removing, which is a positive thing for earnings, free cash flow, et cetera. We talked about they have 10% of the global enterprise business at $500 billion, Uber, Ticketmaster, Adobe, et cetera. Their total payment volume was up 14% year on year. Their revs were up 9%. That does not sound like a stock that should be down 70, 80%, and it won't be for very long in our opinion. Net income was up 20%. Buybacks at least $5 billion this year. For those crypto people out there, they have a PayPal USD stablecoin opportunity. I don't even know what that means, but everyone's excited about it. And Venmo is a verb. There are very few businesses that you can get at a high quality business like Venmo. They're growing that out, the credit card business, the reward business, et cetera. Venmo for business. It's kind of like Kleenex. I'm going to FedEx it. I'm going to take an Uber. I'm going to Kleenex it. I'm going to Venmo is synonymous with peer-to-peer payment transfer. And the focus is on profitable growth. They've cut expenses. They're implementing efficiencies. They're adding value. Their margins are going back up. Profitable growth. We love that. Second turnaround Tom pick is GXO Logistics. This is one of Brad Jacobs' companies. The thing about Brad Jacobs is he is one of the most friendly shareholder, effective managers in the history of public companies. He's executed a handful of public companies, multi-billion-dollar roll up. He's done. He basically consolidates fragmented businesses like the equipment rental business in United Rentals, like XPO Logistics and others. And then he wrote a book, How to Make a Few $1 Billion. And it's nice to read a book called How to Make a Few $1 Billion from a guy who's actually made a few $1 billion doing exactly what he preaches. So GXO Logistics, outsourced warehousing, logistics. They do reverse logistics. What does that mean in English? So like if you return a product that you ordered online, they'll handle that for the company, whether it's Amazon or Nike or whatever the company happens to be. And what happened is, if you remember during COVID, demand for goods went through the roof in 2021, 2022. A lot of people got free money checks from the government. They spent them, blah, blah, blah. Once they got all the goods they could handle, they were sitting at home. Then all the spending went to services from 2022 forward, and the pendulum shifted. And once that happened, a company like GXO that ships goods, that does reverse logistics, that warehouses goods, obviously their volumes went down because they had a monstrous pull forward in 2021, 2022. That is now normalizing. The revenge spending is in the rearview mirror. People are getting back to balance. You're seeing it in PCs, for instance. Everyone ordered computers during COVID. Now they're refreshing those computers, and that cycle is starting again. We're moving from a destocking cycle to a restocking cycle across many of the companies that we own and follow. And GXO is perfectly positioned to benefit. They've effectively, the way they've set up their business, and they're Europe concentrated. That's the biggest slug of their revenues, but also a big business in the US. So they get paid per client unit. So as that comes back, the operating leverage they have in their business, operating as a duopoly, basically with DHL, and that duopoly is getting stronger and stronger as they do accretive acquisitions. And they'll benefit as the conditions normalize. So Brad Jacobs has a proven track record of executing smart deals, accretive deals, as demonstrated from United Rentals, XPO, and he's now employing as chairman, employing his M&A skills with GXO. Great opportunity to participate in roll-up acquisitions by strategically acquiring smaller companies to position itself for the next cycle up. The other thing that's interesting is GXO, while it's basically a duopoly, one of the two biggest, they only have 5% of the fastest growing 430 billion total addressable market, logistics market in Europe and North America. So there's a huge amount of growth to get that's just beginning. And in terms of, will this management team execute? Do they know what they're doing? Are they going to have pricing power? Just look at how they've done it before. If you had invested, $1 million with Brad Jacobs when URI IPO'd, you'd have 47 million. So that was a 47 bagger. If you got involved with XBO Logistics when Brad Jacobs got involved with XBO Logistics in 2011, you made a 31 bagger. $1 million became $31 million. It's not to say it's going to happen with GXO, but multi-baggers are fine. If you only double your money or triple your money over time, as long as it's a reasonable amount of time, you're going to get above market returns, and that's what we look for in any business that we enter. The guidance suggests the business is nearly going to double adjusted EBITDA by 2027. So that is a key thing, because not only does that imply that the stock price could double over that period between now and 2027, potentially, this opinion, not advice. But when you get that growth back, the double-digit top and bottom line growth back, you will get a multiple re-rating, because it's right now trading at a depressed multiple on the basis of recency bias, looking in the rearview mirror, versus the growth multiple it should have looking through the windshield on the future prospects. So not only would you see a doubling as the business doubles potentially in the stock price, but a multiple re-rating, which means it could be a multi-bagger on the basis of that. And that's just in the short term. If you look at the long term, their pricing power is only going to increase as they've got some 25% of the Fortune 100s already. They'll start to get the rest from competition as the scale of the business and these fragmented businesses are no longer going to be standalones. They'll all consolidate into GXO and or its a duopolistic competitor. And finally is Crown Castle Internet Inc. This is a cell phone provider. So here's the bottom line. Their legacy tower business is extremely profitable. They had this small cell fiber business that is now under strategic review. They've brought in a new CEO, Stephen Moskowitz. He had 12 years of experience in American Tower. He tripled American Tower's U.S. operations, became the largest and most profitable wireless infrastructure company, tripling in size to more than 20,000 cell sites under his stewardship. So now he's just come on board at Crown Castle. My guess is that they're going to sell the small cell fiber and focus on their legacy tower, profitable legacy tower business and grow that. They'll use the proceeds from the small cell fiber sale to deleverage, decrease interest expense, and the stock will take off. This is also a key, the key aspect of this investment is that REITs will trade with interest rates. So if you believe that over time the Fed is going to cut one or more times, these interest rate sensitive groups like REITs are going to outperform. And this is one way we can participate. Oh, and by the way, you get a 6% plus dividend while you wait. So we like the opportunities here. And you can see that dividend yield right now is the most undervalued asset group since the early 2000s. And we know what happened next. They dramatically outperformed over the next decade. And we're going to see, in our view, a similar situation as rates come down, dividend yield demand goes up, and these quote unquote left for dead stocks are going to start to dramatically outperform, while the shiny object stocks that have recently led the pack will languish. And with that said, I want to thank everyone for tuning in this morning. This is opinion, not advice. You can see terms at hedgefundtips.com. And do check out our podcast. I think you'll find it very valuable. You can put Hedge Fund Tips with Tom Hayes into YouTube if you want to view it, or anywhere you get your podcast if you want to listen to it. I'm on Twitter at Hedge Fund Tips, and there's my contact information below if you wish to reach out directly. So with that said, if there are any questions, we'll open the lines. Otherwise, thank you so much for tuning in. And we're back. So that gives you 3 good tips that we own. And again, do your own work first. Here's from Buffett, quote of the week: most people get interested in stocks when everyone else is. The time to get interested is when no one else is, and you can't buy what is popular and do well. And that is the core of what we talk about on this every single week. And the 3 names that we talked about in the Money Show clip, PayPal, GXO, and CCI, these are all out of favor, high quality companies that are temporarily impaired, which we discussed in the 30-minute segment. And we hope that was valuable. And for those of you who've been with us, you know the more in-depth analysis that we've done on those individual names in recent weeks and months. Peter Lynch, time is on your side when you own shares of superior companies. We always talk about runway. Balance sheet first, free cash flow second, turnaround plan, maybe new jockey third and fourth. These are things that are critical to our analysis. And once you have those in place, then it's a question of time and patience. And the way it works is the market doesn't just give you multi-baggers for free. They're going to test your will. They're going to test your patience. They're going to throw you up against the wall. And then once they realize that he's not going anywhere, they give you the multi-bagger. And some cases it's super quick, and some cases it takes a little longer. Here's from the Daily Shot. This was the key thing that we had talked about in the article of the week on Tuesday, which was out before the inflation numbers on Wednesday due to travel. Had to be up at 3:30 yesterday to catch the flight at 6. Motor vehicle insurance finally rolled over and turned negative. And what I said was in the article was that X owner's equivalent rent, which trades on a 12-month plus lag, and we know from the Zillow rents and apartment.com rent that rents have rolled over. X, so once you account for the 12-month lag and insurance stops going up, you're effectively at 1.83% headline inflation. And sure enough, finally, car insurance broke this week. I wasn't sure if it was going to break this quickly. And owner's equivalent rent we know is going to break because we see the data in arrears. So this was key. Next is Daryl Bracken, the CEO of VF Corp, pulled out his checkbook this week and wrote a check for $1 million of stock. That's not something you see from a CEO who thinks the company is not going to do well prospectively. So we like that we have a partner that we are co-investing with versus a steward that we're financing. A big difference. Let me say that again. Partner we are co-investing with versus a steward that we are financing, and apply that framework to a number of the companies that you look to get involved in. And I think that will go a long way in helping your investment process. Next, the Fed probabilities of a cut are now up to 68.4% for September. And for November, the odds of at least one cut are up to 81%, give or take. And for December, the odds of two cuts are 69, close to 70% odds for two cuts in December. This is the Fed funds future. And they are 96% for one cut. So as we laid out the case in terms of confidence and direction in the article of the week this week, which was out on Tuesday, we are in fact getting 1 to 2 cuts this week. This year, 2024. All right, moving on. Alibaba's cloud, Qwen2 with enhanced capabilities, tops LLM, large language model leaderboard. It outperformed other leading open source models in 15 benchmarks in 29 languages from Italian to Arabic. So this is a big deal, furthering the AI narrative. Freshippo, which is kind of the Costco of China, which we own through Alibaba, launches private label at North American supermarkets, eyes global expansion. The partnership includes 99 Ranch Market, the largest Chinese supermarket chain in the US. Freshippo plans to launch its products in Australia, Singapore, South Korea within the year. It's amazing, all of the amazing things that are happening with Alibaba that there is zero credit attributed to in the stock. Yet, ladies and gentlemen, and when these things turn, they turn all at once. 3M stock is rising. Wall Street sentiment is turning. Remember this? You couldn't give it away. We were pounding the table. Well, not only is the 3M stock up huge, but we got a free spin out with Solventum, and both of these things are now turning, and we're really excited to own that and to participate in that. Alibaba says new AI model, Qwen2, bests Meta's Llama 3 in tasks like math and coding. So their AI model is now besting Meta's Llama 3, which is a pretty big deal considering the resources that Meta has. Biotech, guys and gals, we've been talking about this for a year and a half. Deals and drugs was the thesis. Well, guess what's happening right now? Biotechs line up for IPOs in bullish sign for US listings market. So the game is back on for biotech. And just to put in mind for newer listeners that haven't been around, this is the story here. you had this big crash in XBI. You buy the lows in March of 2022. You get this monster rally from 61 to 90 in a few months. And just when you think you're smart and you're up 50%, it goes back and retests 61. And the question is, do you hold your nerve? Well, the answer is, did anything change about your thesis that would justify puking out in the hole? And the answer was no. If you believed that, this was 2023, that rates would eventually have to come down, risk would come back on, the IPO market would reopen, and in turn, long duration risk assets would come back. Well, then you wrote it back from the lows to 103. Now it's checking back to the high 90s, and I think just beginning. And you see this pattern over and over. It stays subdued for a year and a half, forms a base, shoots up, everyone buys up, then it checks back and knocks everyone out before it goes on the parabolic move. Same thing here, year and a half, 2-year base, goes back and retests the lows, knocks everyone out, and then shoots up, checks back before another parabolic move. So I think that's where we are on biotech. We covered VF Corp. Chinese stocks poised for another leg up after healthy correction, says Goldman Sachs. So that's positive. Expect another bounce as July Communist Party meeting seen, including more support measures. So that's the next catalyst, ladies and gentlemen, as well as the Stock Connect for BABA in our view. China sees 110 million domestic tourist trips during the Dragon Boat Festival holiday. China call for open mind spurs hope of new housing measures. So the seal has been broken. They're taking the actions and now they're starting to accelerate. And when it hits, it will hit all at once, which is why you have guys like David Tepper, who's one of the greatest of all time, maybe the greatest of all time, in my opinion, having it as his largest position. And we're not talking tens of millions, which is a nice size position. We're talking hundreds of millions. I believe he's got over $1 billion of stock. And it's basically his family office. So he's making a personal $1 billion bet. Buffett partner Charlie Munger kept these rules about investing in life that you can use too. Consider what not to do. That was Munger's. Always invert. Address psychological biases. We've covered quite a few on this podcast, including recency bias, what happened in the recent past. People extrapolate to persist indefinitely, i.e., they think NVIDIA will continue to go up forever, and they continue to think BABA will go down forever, and the reverse is probably the better bet. Address psychological biases, create a circle of competence. We only deal in high quality companies that are temporarily impaired. We don't go out of our competence and areas that we have an edge. We favor high quality companies with a moat, free cash flow companies that have the runway to turn around, ideally with a new proven jockey and a catalyst in mind. And we just do that over and over and over, and we do it very well. Use the power of reading and learning. I can't tell you the last time I've listened to music in the car. I've always got either an Audible audiobook on, or CNBC, or Fox Business, of course, or Bloomberg. I'm always filling my mind with information. Even if I'm hitting balls on the range, I've got my Bose Quiet Comfort 2s. Why? Because they knock out, or if I'm at a swim meet, I'm pounding through books, or at a water polo match, because, at 1.5, I can get through like 5 books a week. So weigh capital allocation against opportunity cost, and that. Chinese AI social media apps see demand rise overseas. Jobless claims jump to highest level in 10 months. These are the job cracks that we need to see for the Fed to move. And the Fed funds futures market, of course, is telling us that they are going to move, and they're going to move 2 times this year, regardless of what they say. Thou dost protesteth. They are never going to tell you until rear view mirror after they do it. Not only did lagging indicator CPI numbers come in lower than expected, but leading indicator PPI, wholesale prices precede headline prices, also fell, quote unquote, unexpectedly, which bodes well When you see unemployment over 4%, when you see prices falling, the Fed will be moving just like the ECB, just like Sweden, just like Switzerland, just like Canada. And even if they're not at 2, they're going to say we have confidence in our path to 2, which has been the script of the global coordinated, what has become easing policy. They're calling removing restriction, which is fine. They can call it whatever they want. It's the same net effect. Wholesale prices drop and add to evidence of easing inflation. Bond market splits from Fed again by betting on 2024 rate cuts, which we covered in the Fed funds future. The Fed isn't really taking 2 rate cuts off the table. That's from Yahoo Finance. Small cap stocks are finally ready to run with the bulls. That's from Barron's Paul R. LaMonica. You can read that. They're just saying what we've been saying for the last handful of weeks. What I'm thinking about now, stock market and sentiment results. This is basically an update on positions each week and some outlook. The first one we did was Alibaba. And a few weeks ago, we covered Alibaba earnings in detail. You can click here for those results. For those of you on an emotional, not fundamentally based roller coaster, let me update you on where we believe we are in the ride sequence. So this is the Justin Mammis sentiment cycle that we've covered many times on this podcast. And I want to reemphasize it because we're at a critical juncture here. And I really want you to see the psychology of investors over time and how closely they mimic the regular cycle all the time. So if you go back to 2016 for Alibaba, when the price was way back as low as it is now, and you were in a period of discouragement, you can see it down here, which follows panic, which follows disbelief, which follows enthusiasm, but discouragement all the way down here. Then you get the first rally out of discouragement all the way back up to resistance, up to anxiety. Then once you suck everyone in who didn't believe it down here at discouragement, you're going to get this aggressive check back to aversion. And aversion, once you start coming out of aversion, you got to knock out the last few people because no one wanted to buy here. Then you got a ton of new money here. You shake those people out, and then you take it back up when everyone starts to think about selling here. Then they buy back here. Then you got to shake them out one last time. And once you really massively screw them, then you get the parabolic move up. And I'm not saying there's no magical hand here. This is just how human psychology works. And that's why, for those of you like, oh, can AI do this? I'm telling you that you have to go through cycles and experience this and see it and live it to become masterful at this. But I'm giving you the shortcuts to cut your learning curve by probably 80% if you take it to heart. The key is going to be whether it's in your DNA, whether you have the ice in your veins in your DNA and you've done enough research on your own, not listening to outsides or secondary opinions about source data, but actually going to the source data yourself with rigor and doing the analysis, that these things you'll be comical. You know, when you get into aversion, you'll be like, oh, we're in aversion. Okay, got it. And then you'll look at the fundamentals and be like, wait, cash flow is growing, revenues are growing, earnings are growing, management's improving, blah, blah, blah. Got it. Okay. And then returning confidence, then they shake them out, and then you get the final parabolic. Then you get at enthusiasm, which is where we were. So buy the dip was in late 2018. Then you got up to enthusiasm, which peaked in late 2020, early 2021. And then you had the collapse down to panic in 2022. And then it looked like, oh, we're going to recover. And you got that shoot right back up to anxiety or to resistance before final discouragement when it shot all the way down to 58. And we were able to pick up a bunch of additional shares at 61 to bring our basis down. Then you got this massive move up to anxiety, straight up from 58 to 118 and sucked in everyone at 118, only to do what? Just flush them back into aversion, which happened early this year, not quite down to discouragement, just enough to take all these people that hated it at 60, loved it at 120, and then they just flushed them back down at 70, and then we shot up to 90, and now we are in what we came out of aversion, shot up to denial, which was back at 90. And now we're doing this check back called denial, where you shake out this money here one final time. And I think we're on the cusp of the move, the parabolic move back to returning confidence. All the fundamentals. So whether it's that communist meeting, whether it's the stock connect, whether it's just finally people decide that they want to sell expensive shiny objects and buy undervalued best AI play in the world called Alibaba and cloud play. I don't know what the catalyst will be, but I know that based on how this is set up and how the underlying fundamentals are tracking, I think we're on the cusp of something really great, and I'm very excited about it. So, in other words, it's probably your last chance to get off the ride at the ticket booth before the fun begins. It appears we're largely through the queasy part of the ride, and it's been queasy that's the understatement of the year. So, Comstock Resources. Remember, you couldn't give away Comstock Resources at $7 to $8 in January and February. You can see this short clip of me with Charles in January. And yeah, me neither. Congratulations to those of you who took advantage with us as this thing shot up from 7 to 12. But this is immaterial in my view. This is early days, just getting started, and we're happy to be. Here's the data that supports what we've been talking about. The average ChatGPT search takes many multiples of energy as to the normal Google search. Here they're talking about 6 to 10. I've seen other data, that's Goldman Sachs. I've seen other companies and estimate it 17 times. So call it 8 times. It's still a lot more energy. Fed. Okay, the Fed, I wrote this on Tuesday. And I said, I have no idea what will happen in the short term tomorrow with inflation numbers or the Fed dot plot / press conference. What I do know is that we've started a global regime of coordinated central bank policy, just as the BOJ was the global liquidity provider, Bank of Japan, cutting rates, printing money, buying domestic and global bonds and equity ETFs, while the West tightened policy to fight inflation. The roles have now flipped. Bank of Japan will now tighten their policy while the West provides global liquidity through slowly easing the magnitude of their restrictive policy. In English, the Fed could cut 2 times and still be 200 basis points too restrictive, as they are currently 233 basis points too restrictive. Fed funds rate minus headline CPI. So this shows the 10-year real interest rate. And then the average person will say, quote, this is very important, ladies and gentlemen. The average person will say, quote, but prices haven't come down, so they have to keep rates high. Keep in mind, prices are not going to come down. They need only start going up less than they have been going up. So when you increase money supply at $6 trillion in 2 years, there is no way prices are going to go back down to 2019 levels. The best you can hope for, their only goal rather, is that price growth goes back to 2019 levels, which is about plus 2% a year, not prices themselves. The only way prices could ever get back to 2019 levels is if they stayed this restrictive for too long, causing a deflationary depression. To contract money supply and prices by that magnitude, you would have to see debt defaults by an order of magnitude higher than we saw in the great financial crisis from 2008 to 2009. They won't let that happen. They learned their lesson in 2008 and acted quickly in 2020 when they were faced with a similar deflationary threat due to the world shutting down. I stand by my view that people would rather pay an extra $1 for a gallon of milk and still have a job versus prices deflating and being long-term unemployed. So how will they cut without appearing accommodative or like they are, quote, easing? The exact same way their colleagues have started cutting around the world in Switzerland, Sweden, Canada, ECB, etc., with verbal forward guidance that looks like this. Quote, we are confident that inflation is moving toward our target. Therefore, while still being restrictive, greater than 200 basis points tighter than underlying inflation, we are going to remove a bit of restriction now, i.e. 25 basis points, while still remaining restrictive, meaning greater than 175 basis points, tighter than underlying inflation, meaning they are not, quote, easing / accommodative until they have cut at least 4 times, which is unlikely to be needed in this cycle if they start by fall or sooner. So while everyone lost their minds over Friday's quote unquote strong jobs report, looking past the headlines told a different story. Do they have enough cover to cut this fall? We believe yes. The household survey data indicated a sharp decline in employment, suggesting that the official figures from the establishment survey may be subject to downward revisions. How do we know this? Because that's what's been happening for the last year. They've overshot the initial establishment number by 500,000 jobs over the last 12 months that had to be revised down. That path will continue. And you can see it here with the unemployment rate slowly ticking up over 4%. True job growth is overstated, but does the job market care? It shows the difference between the overstatement in payrolls and what ultimately wound up happening after revisions. For those interested, headline inflation 3.36, which now actually came down since Tuesday, is running at just 1.82% when you back out auto insurance and owner's equivalent rent, which, by the way, we got our first negative auto insurance, which is super duper exciting. If you're of the camp that we are, that these are abnormal elevations that are set to fall meaningfully on a lag basis, then we're already below the 2% target. And then I said, we'll find out in tomorrow's press conference if the Fed feels similarly to the ECB confidence in the direction towards the inflation target. They did acknowledge, number one, that they're still very restrictive, and number two, they acknowledged that they had confidence that they were moving toward the target, but they, quote, needed more confidence. They will need more confidence until you get to the press conference that says we just cut. They're never going to say we're fully confident and not cut. So that's their forward guidance. If you see the same script from the ECB and Bank of Canada tomorrow, i.e. inflation is headed toward the target, which we did see, we could be in store for a positive surprise sooner and more cuts than the market has priced, 1 to 2 cuts in 2024 versus the negative surprise that is expected of 0 to 1 cuts in 2024. Always remember, the secret to happiness is low expectations, and coming into the meeting yesterday, the expectations were super low, which is why they already started to adjust with a 96% odds of 2 cuts by December, according to Fed Funds Futures. So keep in mind, any possible good news surprise will be cloaked in a very hawkish rhetoric, which we just discussed, saying we need more confidence and more confidence, removing excess restriction but continued restrictive policy versus easing and initiating accommodation. Same effect, different results, different words. Same effect, different words. The key will be an attempt to dampen excessive market enthusiasm, which is effectively what they accomplished yesterday with all the good news about CPI inflation. They came out and tried to dampen that enthusiasm. And however, despite that short-term dampening, we're starting to see a little bit of resilience now going into the close on Thursday. In case you forgot, the Fed began its reduction of the quantitative tightening program on June 1st, despite the fact it was announced on May 1st. This means that they used to allow $60 billion a month of treasuries to roll off at maturity, meaning there was no $60 billion bid in the market each month to replace those securities on the balance sheet, forcing private investors to absorb this excess supply, draining demand out of riskier assets like equities. As of June 1st, this level was reduced to from $60 billion per month to $25 billion per month. What is the extreme significance of this in English? It means the Fed is a buyer of $35 billion more of Treasury per month than they were last month, and for the last 2 years since June 2022. So rather than draining $35 billion per month from risk assets to absorb the Fed's supply, there will be an additional $35 billion of private money available to purchase risk assets, i.e. equities, starting this month. That's exciting, ladies and gentlemen. Let me repeat that. Starting this month, as of January 1st, there will be an additional $35 billion of private money available to purchase risk assets and equities in the market starting this month. I'll be keeping a close eye on whether they mention anything on this front as well. They affirm that's what they're going to continue to do yesterday. It's actually more important than whether they do 0, 1, 2, 3 cuts this year from a market standpoint. Note the 10-year yield peaked just a few days before they made this announcement on May 1st. We expect this trend to continue in fits and starts for the foreseeable future now that operations have commenced in the market. And sure enough, 10-year yields came down quite a bit in the last 2 days. Intel. Last year, we built up a position in Intel at $25 on the basis that the legacy PC server business was worth $45 to $50 a share, and any hope on AI chips or the foundry business was whipped cream. It took off much faster than we anticipated, so we exited 2/3 of the position in the high 40s. Those of you who are longtime listeners went through that whole process and I'm sure enjoyed it. We anticipated a pullback with the remaining 1/3, but it was not a concern as we had already taken a lot of profit off the table. The stock has recently reverted back to the high 20s and low 30s, which enabled us to rebuild the position we sold in the high 40s back at a lower price. We still believe the legacy PC server business is worth $40 to $50 per share. That is our margin of safety. However, if Pat Gelsinger is anywhere in the ballpark about what he thinks he can achieve in the foundry business or AI chip development, the upside could be dramatically higher. We are not counting on that, but we will eagerly accept and enjoy it if he delivers. More likely, the outcome will be somewhere in between, which is well more than a double from these levels and possibly a lot more over time. Our opinion, not advice, see terms. Remember, here's a chart of Intel here. You can see it's done nothing since 2001, 23 years of sideways consolidation. Looks like a big cup and handle, by the way, for those of you who like that nonsense. Remember when Microsoft did nothing for 15 years before they reinvented... Oh, okay. Remember when Microsoft did nothing for 15 years before they reinvented their business? As you can tell, I always speak impromptu. I'll never work well with a teleprompter as far as I can tell, and I don't think I'll ever be in a position where I need a teleprompter. Anyway, I'm open to the idea the Intel CEO, Gelsinger, has the ability to reinvent Intel into something beyond what investors, quote, don't know that they don't know, similar to what Satya did at Microsoft. For Satya, it was software as a service subscriptions and riding the SaaS wave. For Gelsinger, it will be a foundry duopoly with Taiwan Semiconductor and riding the AI chip wave and compute demand. Time will tell. So here's what Intel looks like in, huge parabolic move for 20 years and then 20 years of sideways consolidation. Well, Microsoft had the same thing. Huge parabolic move for 10 years and then a sideways consolidation doing nothing for 12 and then a next parabolic move. So I think Intel could create this type of outcome as they break out from this consolidation, given the tailwinds and their expertise in particular areas that are going to fly in the next 5 to 7 years. It doesn't hurt to have the US government as your co-investor and subsidizer in chief. The government is committed to reducing dependence on Taiwan Semiconductor, the monopoly, and creating a duopoly with Intel. I wouldn't bet against the richest treasury in the world to do so. Many bet against the government's commitment to EVs with Tesla subsidies for many years, and they lost big time. Musk wouldn't be here today without the massive government subsidies in the first 5 to 10 years when it mattered and reselling those credits. And Intel would not be able to compete and create foundries to rival Taiwan Semiconductor without $48 billion of subsidies and loans that they're now getting from the government, which is mind-boggling. Intel is planning a $100 billion spending spree across the U.S. To build and expand factories after securing $19.5 billion in federal grants and loans. And by the way, another bunch that take it up to $48 billion in tax breaks. Oh, here it is, 19.5 in federal grants and loans, and another 25 billion in tax breaks. So you just can't compete with that. That's oligopolistic positioning, and they're going to take full advantage. Now, as far as their earnings, the short-term noise, revenues were up 9% year on year. That's good news. Gelsinger says strong innovation across our client, edge, and data center portfolios drove double-digit revenue growth in Intel products. With Intel 3 high volume production, leading edge semiconductors are being manufactured in the US for the first time in almost a decade, and we're on track to regain process leadership next year as we grow Intel Foundry. We are confident in our plans to drive sequential growth throughout the year as we accelerate our AI solutions and maintain our relentless focus on execution, operational discipline, shareholder value creation in a dynamic market. Q1 revenue was in line with our expectations. We delivered non-GAAP EPS above our guidance, driven by better than expected gross margins and strong expense discipline. Okay, blah, blah, blah. And they expect 200 basis points of additional full year gross margin improvement, which is phenomenal. So revenues were up, gross margin was up, R&D was up, operating margin was up, net income was up, and earnings per share was up. So that's all good. Foundry operating model is a key component for the company's strategy and is designed to reshape the operational dynamics and drive greater transparency, accountability, and focus on cost efficiency. It's also designed to shift Intel from being a commodity producer of PC and server chips into a duopolistic producer, foundry producer of high-end CPU and GPU chips and everything needed for AI. The other key point here, in my view, one is the idea that it's a duopoly, but the other thing is Western governments are going to be politically pressuring all Western corporations to buy away from Taiwan and China and buy from Intel. So not only are they giving Intel effectively $48 billion to create a duopoly with Taiwan Semiconductor, they are going to be pressuring all of their companies to buy from Intel versus Taiwan Semiconductor. So, and by the way, that's not baked into the $45 to $50 a share fair value. That's the $100 or $150 if all the pieces come together, the free option. And here we can buy at and are at $29, $30, $31, which is super duper exciting. Not as cheap as we were able to get the core position last year, but still very cheap. Okay, so Intel continues to advance its mission to bring AI everywhere. As of the end of the first quarter, more than 5 million AI PCs have shipped since December 2023 launch of Intel Core Ultra processors supported by more than 100 software vendors. Intel expects to exceed its prior forecast of 40 million AI PCs by the end of 2024. As far as at Intel Vision, the company introduced Intel Gaudi 3 AI accelerator projected to deliver on average, listen to this, guys. Gaudi 3 AI accelerator is projected to deliver on average 50% faster and 40% greater power efficiency than NVIDIA's H100 chip. Okay, so it's going to be 50% faster and 40% more energy efficient than NVIDIA's H100 chip. No one's talking about that. No one will until they do. And that's the key thing. They also announced an increased expected lifetime deal value for external customers of more than $15 billion. They got a huge contract with, of course, the Defense Department. What do you know? Pressure to use Intel versus others. And, okay, pipeline of 50 customer test chips, et cetera, et cetera. So the hits just keep coming here. It's turning the ship around. Gelsinger's been there for 3 years. It's 5 nodes in 4 years is on track. So let's just cover some key things. We covered the faster and more efficient than the H100 chip. and they got the $48 billion from the U.S. government. Okay, we got that. CHIPS Act. They're going to have over $500 million in revenue in the second half just with Gaudi 3, so that is just getting started. Gross margins were up 6% year on 6.7% percentage points year on year. I want to get through some of the key things here, and then we can get on to the Ask Me Anything questions. Here we are, $45 billion of proposed grants, tax incentives, and loans from the CHIPS and Science Act. That's a big deal. We have built a Grovian culture and execution engine and are on track for completing our 5 nodes in 4-year goal. Grovian culture refers to Andy Grove, who built Silicon Valley, who personally mentored Pat Gelsinger, which is one of the reasons I want to make a bet on him. No one was better, and Gelsinger is cut from the same cloth, which is very, very good. Betting on the jockey here. We are defining and leading the AI PC category. Good traction with the Intel Developer Cloud with customers onboarding with this platform. Now we're talking about the Gaudi 3, including Dell, Seeker, our largest IDC win to date. And this shows you the size of the top 10 semiconductor foundries. In short order, Intel will be starting to knock on the door with Taiwan Semiconductor, and they'll basically have a duopoly with an unfair advantage to Intel in that all of the Western companies will be pressured to give the business to Intel once they're open for business effectively. The transition from pre-EUV wafers to post-EUV wafers is a powerful tailwind for us. We expect our blended average wafer pricing to grow 3x faster than costs over the decade, driving significant margin expansion. What happens when you get margin expansion? You get multiple re-rating. So you get 2 bites at the apple is what happens, and that's when you get parabolic stocks. When they go from growing at single digits to double digits, and then they get multiple expansion on top of the double-digit growth is how you get stocks that just hockey stick up, and I think they're setting themselves up to be one of them. Okay. Both dynamics are in our control and not dependent on revenue growth, and are key elements to drive the business to break even, more than doubling our current earnings power at the Intel consolidated level. More competitive wafers, combined with our position as the only company manufacturing with leading edge wafers outside of Asia, is drawing strong interest from potential external customers. This is just starting, ladies and gentlemen. Pleased to announce this quarter we signed another meaningful customer with the Intel 18A, bringing our total to 6, a leader in aerospace and defense industry. This customer chose Intel Foundry based not only on the process technology benefits of Intel 18A, but also because of their desire to have a secure US-only supply base. Just this week, we are very pleased to announce that the Department of Defense awarded Intel Foundry Phase 3 of the RAMP-C program, which we are confident will lead to additional federal, aerospace, and defense customers. This is a big deal, ladies and gentlemen. This is going to be a duopoly with an unfair advantage to the American part of the duo, which basically means monopoly. Okay? So if you look 3 to 5 years out and you believe their plan is on track, 5 nodes, 4 years, and the government support, you wind up with a monopoly foundry in the space. And I like, what was it? Peter Thiel said competition is for suckers. So I think Intel has read his book. Okay, while we are highly focused on improving the near-term profitability of Intel Foundry, it is also important that we keep sight of the long-term opportunity here. The foundry market is expected to grow from $110 billion today to $240 billion by 2030, with almost 90% of the growth coming from EUV nodes and advanced packaging. Given this backdrop, we have a clear line of sight to building our EUV high NA process technology leadership, advancing in packaging manufacturing capacity, our systems expertise, and the surge in AI demand. Oh, listen to this. Given this backdrop, we have a clear line of sight to becoming the largest system foundry for the AI era and the second largest overall by 2030, building on our EUV high NA process technology, leadership in advanced packaging, manufacturing capacity, our systems expertise, and the surge in AI demand. So you want to go panning for gold like NVIDIA, or you want to go to war, or you want to be the arms dealer, is basically what they're saying. Because all these guys, and I've talked about it on Cavuto, I talked about if you think people are going to sit back and let NVIDIA keep 70% margins in a relative commodity business, you're out of your mind. They're going to be gunning for each other, but Intel is going to be selling the arms to all the combatants and making a mint as they destroy each other and erode each other's margins. Intel is going to be the beneficiary of that competition as a basic monopoly in the space, with pressure for all of these companies combating each other for margins to give all their business to Intel for the production. This is a big deal. So semiconductors are the currency that will drive the global economy for decades to come. We are one of two, maybe three companies in the world that can continue to enable next generation chip technologies, and the only one that has Western capacity and R&D, and we will participate in the entire AI market. Quarter by quarter, we are positioning ourselves well to capitalize on the immense opportunities ahead. It's a big deal, ladies and gentlemen. Okay, sentiment neutral, fear and greed neutral, National Association of Active Investment Managers kind of neutral. So that's sentiment. Earnings, listen to this, ladies and gentlemen. Top 30 weights, S&P 500 cumulative earnings power in the last 60 days was revised up 3.15% for this year and up 2.5% next year. If you think that's exciting, how about small caps was revised up by 7.7% for this year and 5.56% for next year. So as those Fed funds futures price in more, market starts to digest this, these guys are going to run, and all the baskets we've been talking about that will benefit from slightly lower rates are going to start to take off. And the shiny objects everyone has been chasing will run into a wall, and that'll be that. So we covered the basic core here. Core PPI came in at 0 versus 0.3%, expectations versus 0.5% last. Year-on-year core PPI 2.3 versus 2.5 last, 2.4 expectations. Initial jobless claims came in higher than expected, so cracks in the labor market. PPI month-on-month was negative 0.2% versus plus 0.5% last quarter, 0.1% expectations. PPI year-on-year 2.2 versus 2.5. Ladies and gentlemen, we're at their target. I would say they just don't know it yet, but they should know it. If they got 100 PhDs working there, they can certainly see what I see. And like I said, they're just going to guide hawkish until they actually cut. And then in the rearview mirror, they're going to tell you, they're not going to tell you prospectively, otherwise they would just take the action. Next is earnings estimates. Again, keep climbing up, 244.73, 279.08, which implies greater than 14% earnings growth, 11% this year, etc. Okay, the podcast is over. We are now going to start the Ask Me Anything questions from our audience. If you want to stick around, please do. Otherwise, we'll be back next week, same time, same place. So, question number 1, John Tay, any thoughts on Match? We cover this every single week, so I'll cover it one more time. We don't like this business because there are 0 signs of growth. It's cheap. We've looked at it a million times. Free cash flow keeps growing, but revenues have been flat for like 10 years. I would say, look, if I was going to go into this, I'd want to know what's happening with the active members. So that's something you need to see. Are they growing active members, or is it declining? If they're growing active members, or it's relatively flat. The issue here is you got the same revenues in 2024 that you did in 2015. So it just looks like a stale, deadish business, but their cash flow keeps growing, which is why I like it. And the balance sheet, let me just get this thing smaller. Yeah. I think the balance sheet was good. Let's see. Yeah. 864 cash, 3.8 billion in debt. Not terrible, not great. And then free cash flow is probably pretty good. Yeah, about $1 billion. So I think that I think you're probably okay here. Okay. You just really have to know, is there a competitive moat? Even though they're not growing revenue, are they keeping members? And I think you probably got something here. But understand the competitive landscape and understanding it, as long as their members are using it and paying, I think you'll probably get a re-rating over time. I just don't love the flat revenues, which is why it's kind of like an opportunity cost. I could deploy better elsewhere, but I think you're probably cheap enough at this point, and you're probably due to start to see some type of recovery. I'd also want to hear the management's plans to re-accelerate, and that would give me more confidence to take a punt down here. Great find, John Tay. Jason Johnson. Quick question regarding the Alibaba dividend that was paid yesterday. Apparently, they lowered the share price by the dividend amount, which makes no sense to me. What's the point of a dividend stock is just going to go down by the dividend amount? Can you explain why they did this? Never seen anything. They didn't do anything. The market does that because the stock is basically trading more or less well below its liquidation value. So when you take cash out, it impacts the stock price in the short term. It's all nonsense. The business is re-accelerating to double-digit growth. It will get there. The multiple will re-rate. We are right on the cusp of the returning confidence parabolic move, in my opinion. We are just now in the discouragement phase where everyone's discouraged. That's the purpose of the discouragement phase. So that's how we view it. Okay, let's see here. Next is Mark Sturm. Quick question regarding Alibaba. From your experience with similar situations, do you think that the narrative that, quote, China is uninvestable can persist indefinitely, or will the price eventually shift back towards intrinsic value? The answer is, I would ask you, how many times out of 10, when you step off the top of a skyscraper, will you go up? And if the answer is 0, some laws are immutable, and price reverting back to intrinsic value is as inevitable and as immutable as the longer you hold the beach ball under the water and the deeper you push it under its intrinsic value, the higher it's going to bounce up when it's finally let go. And this time will be no different. And the beauty here is not that just the fundamentals have held in; they've actually improved while the beach ball has been held under the water. So yes, certain laws like gravity, price reverting back to intrinsic value, but it will not only revert back to intrinsic value, it will exceed intrinsic value in as much mania and euphoria as we are now experiencing in despondency and depression. So it will overshoot both ways, and hopefully there'll be enough smart people on this when the stock price is meaningfully higher that say, hey, Tom, the stock is now trading at 35 times forward earnings and growth is slowing. Why are people paying so much money for this stock? And I'll say that because that's what people do at this part of the cycle. They're euphoric. You'll have people jumping up and down on TV and naming their dogs after Alibaba. And that'll be time to start to lay off some stock and say sold to you. We're nowhere near that now, but I think we're on the cusp of the process towards that. So good question, and moving on. Sam R. I understand that Buffett and Munger don't like EBIT/EBITDA, yet most of the businesses you have mention these metrics. Am I mistaken, or do they have some value? They have zero value. They do that because that's how Wall Street sell-side bankers sell debt to the buy side. Is basically, it's an invented, made-up metric in order to sell paper to the buy side. That's the basis of it. So, which is why I rarely, if or never, will buy a business run by an investment banker. But what I will say is that while the companies we own disclose EBITDA and ridiculous metrics like adjusted EBITDA and all that nonsense, we look through the noise and focus on free cash flow per share, revenues per share, earnings per share. And they can say whatever they want about EBITDA and one-time adjustments and nonsense. That's fine. That's advertising. What we care about is if we put out $1, how many dollars do we get back in the future, and at what discount rate are we willing to discount those relative to the risk? And that's what we do over and over. So we don't care what they say. We care how we analyze it. Okay, so if you're just analyzing the advertising you're being sold, that's going to be problematic. But if you dig under the surface, whatever they disclose is immaterial. They're going to disclose what they disclose. The key is what you analyze and go through the source materials versus secondary materials to draw your own conclusions. And that's what it is to be an independent thinker. And I hope that you have started to take that message away from our podcast. Joe Smith. Okay, so he sends this Wall Street Journal article where it says people are buying used cars versus new cars. I get real-time industry data on new car sales, and what I can tell you is that new car sales are up year on year. So it's a nice sensational anecdotal article, but it has no basis in current fact. Moving right along is John. John says, hey, Tom, I came across your YouTube videos a few months ago, and I like how you think. Buying stocks at good valuation obviously makes sense. I do, however, struggle with knowing the correct value of a stock. Can you share your 2 favorite ways to value a stock? Something that an average investor can do. Thanks. So there's no metric or magic metric that's going to say, oh, if I just find stocks that have this price to book or this price to free cash flow or this return on equity, I'm going to make a ton of money. So the short answer, John, is there isn't a quick fix. The long answer is what I suggest to everyone is to read The Intelligent Investor by Ben Graham. It's Warren Buffett's favorite book. It's the one he recommends to everyone. And that's going to give you a starting framework. And from that investment of a day or two to read the book, the light bulb's going to go on. And you're either going to say, wow, I love this, and I can't wait to commence the treasure hunt of a lifetime, every day skipping to work, looking for great businesses at reasonable prices. Or you're going to say, this is too hard, and you're going to put the bulk of your money in an index fund, or you're going to find a manager that can deliver in accordance with the framework that can perform for you in accordance with these principles. And many of you have done that, and I'm very grateful for that. And many of you will moving forward, and some of you will do it on your own, and others of you will say, look, I just want to run a business, and you'll put it in passive ETFs and compound at 7, 8, 9% a year and be happy and double your money every 10 years versus every 3 or 4 years or whatever it is you're after. So I would leave it at that, but that's your starting framework. And then if the light bulb clicks, then you want to read every Warren Buffett letter that he's ever wrote. You can find them on the Berkshire Hathaway website, and then security analysis, and then et cetera, et cetera. And then once you've done that, send in another AMA question. Let me know where you're at, but you're on the right track, and so glad you found us. Bill Carr. Can't thank you enough for the VideoCast education and market perspectives I look forward to every week, and have been doing well with several of your covered equities. it's helping in making solid progress toward meeting Great Hill capital minimums. Oh, well, thank you very much. That's very kind of you to say, Bill. So while I don't believe UGI will quite meet your double in 3 years foundational goals, I'd be interested in your thoughts on this utility that is beaten down and seems to be ready to recover once the Federal Reserve blinks. Good yield while you wait. Debt refinancing seems on target. Recently reported significant. Okay, UGI. Okay, so they have a 6.5% dividend yield. All right, let's see here. This is just an early analysis. You'll have to go through the cap structure and see when everything matures and how are their bonds rated. But it looks like they're actually recovering. They were negative free cash flow. Revenues are a little choppy, but okay. Their margins have been cramped. It's not a perfect setup, but I think you're probably okay to collect some dividend until this thing recovers. I want to know why their revenues peaked in 2022 and have been going down materially. Did they sell off a division? What happened there? Let's take a look at their balance sheet. This is probably going to be the issue. 263 million of cash and 6.7 billion in debt. So that's your problem right there. I mean, what it's pricing in is that they could go bankrupt. So I want to know when their first maturity is and how much is it and what was it at and what's it going to be at. And then kind of work from there. I wouldn't be willing to take that level of risk for a 6% dividend yield, but they're probably going to figure this one out, even if the regulators, the last thing the regulators want is a bankrupt utility, except in California when they try to bankrupt all their utilities, but it's still such a good monopolistic business. It's even with the bureaucrats working full time, they've been unsuccessful to bankrupt them. And I think UGI will be no different. So you're probably okay, but you really have to understand that balance sheet. And I think that's a pretty decent find. Bill. All right. Moving along, Paul Falcone. I know FMC has come up in the past on the podcast. Current CEO just resigned and they brought back the old CEO. Industry is going through a destocking period this year, similar to many situations right now where folks overordered during the last few years. Stock is down 58%. Sales are down 28%. Obviously, cyclical business seems like a decent opportunity. Yeah, we've said this one is fine, or we liked it. Let's just take another quick look and see if anything's changed in our view. I think from these levels, you got a decent margin of safety. Like with all value plays, it will go against you before it turns for you, so just accept that. But I generally think they're turning the corner, free cash flow positive. It's got a good business over time. Revenues have a history of being cyclical, I'm sure. Yeah, so they're back to 2019 levels and everyone's panicked. You just want to hear the plan on what's going to turn it around, and that just comes from doing the initial work. But at first blush, let's take a look at the debt here. Well, first off, all right, so they're free cash flow positive again. The balance sheet looks like it is, they're a little levered. Look, any company levered until there's some confidence about cuts. So now we get to see the Fed's been in a quiet period. Now they're going to parade them all out again, probably in the next 2 weeks. And we'll see how they want to narrative shape the market. I think there will be a lot of acknowledgement of the level of restriction, and rather than talking about easing, they'll be saying how they're going to be able to pull back some of the restriction and stay restrictive. And if that becomes the narrative, then you're going to continue to see markets pricing in 2 cuts before the end of the year, which is going to send like stocks like this up very, very quickly. And the whole basket and a lot of the others that we've been talking about are going to move, and they're going to move abruptly, kind of like we saw in Q4 of last year, which made for an unbelievable year because of that. And I think we're on the cusp of phase 2 of that. So good work, Paul, as always. Okay, Justin Pizzo. Can you take a look at Will C? WILC. Good Food International. I've never heard of this one. All right, WILC. So this is a tiny company, 131 million market cap, 10% dividend yield. No estimates because it's too small. What do they do? Distributes food products worldwide. Mushrooms, artichokes. Looks like fruits and vegetables. This is probably a low margin, tough business, but let's take a look here. Yeah, 22. So their margins are compressing. 22% gross margins down from 32. Stock is down, what, 50%? And free cash flow re-accelerating. Like, I just don't like this business as a matter of fact. Now, if you're asking me, so revenues have basically been flat for 4 years. If you're asking me, is it a good trade and could you potentially double your money? Let's take a look here. Balance sheet looks okay. Yeah, I mean, I think that I think it's worth a look. I think, Justin, I know how you got here mentally, but I think you really have to do a lot of work. This is going to be a high risk, high reward company, or high risk, medium reward, which is why I would be a pass. I'm okay with some level of risk if I have a multi-bagger future. I think with this, you're taking decent risk for a double, and so just understand what's the story to re-accelerate growth. And if you can get comfortable with that and their competitive advantage, you probably could have a nice business over the next 3 years. So good work, but do the work before you lean into that. Pfeffel, Donjay. On your CPS thesis, not sure if you have talked about this. How do you get comfortable with increasing ride sharing and easy access to Uber, taking away some of the future demand for purchasing light vehicles? Seems like a structural change is going on, or does it not matter so much as there will be strong enough demand? Yeah, I think this is number one. Ubers are cars, so there's still demand for new cars. Number two, the bulk of the population in certainly in the U.S., which is a preponderance of their business, is 34 housing family formation. Even if they were taking Ubers during their 20s when they lived in the city, they're all now moving out to the suburbs and doing so in big numbers over the next 5 years. They'll be moving to 0 cars becomes 1, becomes 2, and that's going to overcome that, number one. And number two, I own a lot of cars, and I take a lot of Ubers. So what else do you want to talk about? So no, this is anecdotal stuff. Good question, but low impact. Moving along, Manik. Will the political turmoil in several European countries result in the dollar remaining stronger than it would have over the summer, or is it irrelevant? I don't care what anything does over a 2-month period, but irrelevant. John Lipsis. All right, John's calling for a recession. Good luck with that. Steve Jadash. Okay, that was from that. Monique Bojwani says a lot of talking heads have said that the market will rally after the first cut, but then tank after about 6 months. The euphoria turns to fear of perceived market weakness that necessitated a rate cut in the first place. Are you aware of the historical data that supports this as a more likely or less likely outcome? Yeah, these are all the same people that have been calling for a recession for the last 2 years because the yield curve has been inverted, because they're stuck in recency bias of 2007 and 2019 and 2020 versus looking back a little bit further and seeing that from 80 to 82, the yield curve was inverted over 2 years when you had a similar inflation aggressive tightening cycle, and then you had an 18-year rally without the recession. And we did have the recession in 2022, first 2 quarters of negative GDP growth. So it's looking at the right models. As far as will the market crash after 2 cuts, this is a mid-cycle demographically driven. Go back to the Money Show presentation that I did. This is more like 1995, where we'll get 1 to 2 cuts and then we'll be off to the races. And that's probably all they'll need so long as they start this year. If they wait too long, then it will create the scenario that you're talking about, which I don't anticipate will be the case. And if I had to place a political bet, if you remember Trump and Powell's relationship, odds are on him cutting before the election. I would just put it that way. John Lee, thanks for the insights. Wanted to ask, for companies with a large amount of debt as part of their capital structure, is it okay to calculate free cash flow without interest payments? You always have to calculate interest payments in your analysis. So, and most of John Malone's companies have too much debt, by the way. So I'll leave it at that. Q-Rate is a low-quality business. For me, it's a pass. But good question and good analysis, John. All right, so with that said, we'll be back next week, same time, same place. In the meantime, make it a great one. Bye for now.